Okay, welcome back. The This is the answer key for the chapter 11, 12 practice set, which would be week 6. Okay, I don't have the problems in front of me, so I'm going to wing it. The probability, you were given some probabilities and some possibilities. To get the expected value, you simply take the each possibility times the probability. So 100,000 times 25% gives you 25,000. 50% of 200,000 is 100,000. 25% of 400,000 is 100,000. Add those together, and that gives you the expected value. For problem 2, the that was I think a casino license and then a commercially viable. Those are joint probabilities, so you're going to multiply the 20% probability of getting a license times the 70% probability of commercial liability, which would give you 14%. Problem 3 is kind of an interesting one, because it kind of depicts reality as far as the competitor's response is 40%. If the competitors respond, you have a 25% probability of a positive net present value. If the competitors do not respond, which again has a probability of 60 because there's only two things they can do, either respond or not respond, the you have a 65% probability of a positive net present value. You would then take the joint probabilities across the positive. Again, if they respond, 40% times 25% is 10%. A 60% times 65 is 39. Add those two together, you get 49%. Problem number 4 is just to drive home some of the terminology there. Again, the expected value is just the possibilities times the probabilities, and those summed would sum to $104. Remember, the expected value is not one of the possibilities, it's the average that you would average if you took this repeated project to infinity. Okay, the median, again, I put this on there because a lot of times when you have the median, you were taught to count to the center. That works if you have equal probabilities. Where you do not have equal probabilities, you got to use the probabilities to count to the center. 15 plus 30 gives you 45, plus 10 puts you at 55. That's where the 50%, you cross 50% here. So your median value is $280. Then you could do it the other way. 10 plus 15 is 25, plus 10 is 35, plus 45, plus 10 gets you there. $280 is your median. The mode is the most common, which in this case would be the 30% probability, which would be the negative $320. Problem 5, you were given some initial outlay and some cash flows under several different situations. In other words, competitors responding yes or no, state of the economy weak, normal, or strong. When you run the net present values, again, you're going to bring them back at 82,000 for the first one. A normal economy and competitor response 74,150 for that one. 264,000 negative 8,696. Positive 252,115, and a positive $565,089. And so there's your table there. In this case, if they were equal probabilities, you would probably do this project because your winnings, if you want to call them that, are greater than your losses. And then I think we said in the problem that the competitor is only likely to respond if if there's a strong economy. So really, you're looking at these 5 right here, not that one right there. In other words, the 82,000 negative would probably not occur. Then we added some probabilities for the weak economy, normal economy, and strong economy, and then some probabilities for the competitor's response. The economy, those are a little hard to predict, but competitors' response, you would typically predict those from the history you have with your competitors. So you're going to take the 20 times the 40 to get 8. You're going to take the 60 times the 40 to get 24. 20 times the 40 to get 8. 20 times the 60 to get 12. 60 times the 60 to get 36. 20 times the 60 to get 12. Those are your joint probability tables. You're then going to take those joint probabilities, multiply it by the possibilities. Those were the net present values you ran earlier. So 8% of 82,000 is 6,587. 24% of 74,000 is 17,796. Add those up and you get an expected net present value of $189,889. Problem 7 is a pizza parlor. You sell pizzas for $16.75. Your variable costs, I forget what percentage I gave you in there. I'm just 32%. So you take 32% of $16.75 gives you $11.37, not 37, but 39 cents as a contribution margin. So to get your break even, what you're going to do is you're going to take the 414,000. Those are the fixed costs that you're trying to cover, divided by your contribution margin per pizza, and that gives you 36,435 pizzas. You can then turn around and multiply that by the 16.75, and that gives you your plus that times 16.75. I guess what did I do here? Oh, use the old one. The old price, or is it? Maybe it is 12. I don't have the problem in front of me, so I can't tell whether it's 12.75 or 16.75. So 16 probably, and that would give you 610,294. But again, I don't have the problem in front of me, so I can't say. Yeah, this must be correct though, because that's what I use to grade your assignment. So um, yeah, hold on now. Yeah, okay, I'm just going to assume that that's correct. The problem 8, because I can't negotiate over to the or navigate over to the assignment. Okay, you were given some information here. You were asked at $650,000 in sales. What is the net present value? So again, you've got an initial outlay. You've got sales. You have fixed cost of 257,750. Naturally, those are negative since they're costs. You have variable expenses of 36%, so you're going to take 36% times 650. You're given depreciation expense of $32,000 per year. You then are going to sum those. That gives you a taxable income of 126,250. Your taxes are 27% of that amount, so minus 27 times that number gives you an outflow of $34,088 for taxes. This gives you an after-tax income of $92,163. You're going to add back the depreciation because, again, that was in the initial outlay costs. The depreciation is merely a recovery of a prior cost through taxes. When you take the 92 plus the 92,163 plus 32,000, that gives you 124,163. We give you a disposition value of 400,000. So down here, you're going to add any disposition stage cash flow, which there is none in year zero. Operating cash flow, none in year zero, plus your initial outlay. That gives you a total of 456. Copy that across, and you'll get these numbers here. The last one is 524,163. You bring these back to present at 9.25%. That gives you a present value of future cash flows of 953,276. Net that against the 456,000 gives you a net present value of 497,276. Problem 9, then, or you're asked to do a goal seek on that to determine what the break even level of sales. So you can put any number you want out here and put 100,000 in here. And okay, I noticed then at 100,000, they were not going to break even. And so what you're going to do, and again, this is all in the lecture slides for the week, you're going to go to data. You're going to go to what if. You're going to go to goal seek. You're going to set this value here to 0 by changing this value right here. In other words, that one to 0 by changing your sales number. What do we need in sales for this thing to break even in that present value? Hit OK. And it comes back 482,320. You subtract your cost, you have 18,934. Take taxes away of 5,000, gives you 13,822. Add 32 to that, gives you 45,000. 45,000 across. Your disposition value of 400,000 added to that gives you 445,822 at the end. Bring that back to present at, hit OK. Bring that back to present at 9.25%. You get 456,000, which again, this is really kind of a powerful tool here because that tells you what you need to break even in net present value terms, which is a much better measure of the project's risk than just a straight income break even. Because again, here you're covering your initial outlay costs with the net present value break even. Okay, thank you for listening. Let me know if you have any questions.